Welcome, everyone. Thank you so much for joining us. We wanted to do a kind of quick market update and more of a chat just to hopefully be a voice of comfort during these uncertain times. So Matt and I thought this would be a good opportunity to just kind of regroup, uh, see where the market is, why it's behaving the way it's behaving, and then some of the things that we're doing internally, and opportunities that we see when the market does behave this way. So welcome to a May market update. So I'm here with Matt. Matt's our Chief Investment Officer. As you may already know, we believe in streamlining portfolio allocation. So Matt spearheads the portfolio designs, and he works very closely with our portfolio analyst. So the investment dream team is in place, and I am a senior wealth advisor, kind of spearheading planning opportunity. I like to say the phrase making lemonade out of lemons, which my husband hates, but I'll say it because that's exactly what financial planning is all about. So what we're hoping to cover today, I'll walk you through the agenda. But before we jump in, you guys all know us. So we are a growing team. We've been around since 1980, so we're doing something right. As you know, Ben Tobias set the foundation to what holistic financial planning and wealth management is all about. And so we've been guiding families through that financial planning journey since 1980. So we're doing something right. We are now a team of, over 18 people now. The beautiful thing about what we're doing on the team, which I think you should all know and care about, is that we're kind of developing that talent and really focusing in on the core values of who we are and what's important to us, which is the client first. So that's exciting that we've been able to develop talent internally. We're managing now over $600 million, and that's a testament to the value that we bring to the lives of our families. And of course, it's so important to us that all of our advisors and our team members are credentialed. So we're talking about a team of people who are CPAs, enrolled agents, certified financial planners, chartered financial analysts, all the little acronyms after the names.
Great. And hi, everyone. My name is Matt Sainholtz, and I'm happy to be here. As we get into the presentation today, just a quick reminder today is all about education and kind of giving an update on the markets. If you have any questions about your specific situation or your portfolio, please give us a call, and we'll be happy to go over all in great detail how your portfolio is affecting your financial plan. A reminder just kind of how we think about the markets and how we think about what we can do for our clients' portfolios. One of the biggest things we can do is create a structure to your investments. So by creating an investment plan that focuses on risk and reward and diversification and reducing expenses and taxes wherever possible, and really kind of focusing on what we can control. As you'll be able to see as some of our data and some of the information we're presenting today, we can't control everything, but we want to put ourselves in position to take advantage of market opportunities where we can.
So what we'll walk you through is Matt will go over just how the market has been behaving year to date. So we'll go through the return of each sector. We'll talk a little bit about what's driving performance. We want to give you some historical context. What's happened in the past is not necessarily indicative of what's going to happen in the future, but it's important for us to see how the market has behaved during very specific times. So we'll want to put a couple of things into context. We'll talk about how we use current market conditions for planning and really keeping that eye on long-term investing. So those are just some key things we want to hit on. You will see that on your screen, you have the ability to ask questions. You can type them in if you'd like. We'll try to get to them in the few minutes we have together. But as Matt mentioned, you can always call us and we can look at your portfolio in particular, and always just do like a little pulse check on how it's really lining up with all of your goals. But definitely there is a chat feature in this webinar.
Okay, well, we'll go with the bad first. We've had 7 consecutive down weeks in the S&P 500, which is the barometer for US stocks. And so that has only happened 3 times previously. And we're down about 15% in just the last 7 weeks alone. A lot of red on your screen if you're should be able to see our PowerPoint here, where we have year to date. We have the S&P 500 down almost 18% year to date. The Dow Jones Industrial only down 13%, but the tech-heavy NASDAQ, a lot of the technology names are down 27%. And we can kind of go into some of those types of companies, as well as foreign stocks, small company stocks. The year to date has just been rather ugly, to say the least. Potential sectors, one bright spot was energy, and commodities have been pretty strong this year. We've in the portfolio have a section towards commodity exposure, and we've that part of the portfolio has had positive returns. But as you can see on the other side of the equation, some other sectors, consumer discretionary, that's the consumer being weak as far as like Nike and some other type of brands, consumer spending, communication services, information technology. These are your traditional tech names, and these are just been beaten up pretty bad. And then at the bottom of the screen here is also the bonds. The other part of the portfolio, most people think about the stock market being not so great, but also the bond side of the equation hasn't been great either, which it happens sometimes, but usually when the stocks are going down, the bonds act as kind of a stabilizer in the portfolio. Well, year to date, the bonds, as measured by the U.S. bond aggregate, is down 9% this year, and that is due to raising interest rates, trying to combat inflation, which we'll dive into. So,
yeah, if I want to chime in, Matt, just did you want to cover anything else and just kind of put a little bit of color here on this particular slide?
Go ahead.
So we're just talking, to be clear, we're talking about how each of the index behaved. This is not exactly how our portfolios behave. We're just talking about the market broadly. And it's very hard to time the market. You hear that often, well, it's now a good time to start a new portfolio. It's very hard to time the market. But as a long-term investor and us helping clients think through long-term portfolio design, we know that these moments will happen, and they're also captured in our planning. One of the things that we did really well, even though we're not covering performance of our clients' portfolios here, is that we were able to make quite a few shifts that, we say this phrase, it's participate in market upside, but more importantly, protect on the market downside. That's really the secret, even though secret's out, that's really the secret to a long-term portfolio design. And so it's hard to time, right? Because we don't know what it's going to do. I have a crystal ball, but it doesn't work. It doesn't tell me anything. So all we can do is figure out what kind of portfolio a client needs, and then select from each of these different asset classes how much of each asset class we want to incorporate in that portfolio so that we can have this result, right? This result that is driven by your goals. And so one of the things that we did do really well this year is kind of looking broadly and stepping back, looking at the fundamentals. We did some really amazing moves that helped us really protect client portfolios on the downside. So that to us is really, we joke, we're like, okay, now let's play who's the biggest loser, right? So S&P was down 17, but our portfolios, if it was nicely balanced, didn't experience the full decline of the market. So I think across the board, every single sector, our portfolios ended up beating its benchmark essentially. So that was kudos to the whole investment team that was able to think about energy and sort of the outlook on all of these different asset classes. And even in the bond side, because we said there was nowhere to hide, but we did, Matt, remember, you know, and I think it was between the investment committee call that we determined that we knew with interest rates expecting to go up because we were already at the bottom, you know, we had to keep duration of those bonds as short as possible so that we wouldn't see the full impact of a 10% decline on bonds. And so kudos again to the whole investment team because we made those calls and it really helped with the results of our portfolios.
Absolutely. Great points, Nella. You can't get out of the way of the market, but you can definitely do some things to tilt and to hedge against some of the downside as well. So, and to that point, you know, we wanted to just show how what the markets have done this year has not been great. And we're just going to hit it home with some data that shows, as Nella was talking there, you know, as the bond market as a whole, not necessarily our portfolios, but the bond market as a whole, as of April 30th, we're down about 9.5% year to date. The worst start to the ever from the bond perspective in many years. And so when you see this, you know, the start of this 2022 is the top of the list here. It was down 9.5%. Again, due to the rising interest rates and the threat of higher inflation, bonds have interest rates have increased, which brings down the value of your bonds. But you know, we try to put a perspective on it. You know, that's what we're trying to do today, is kind of put some perspective on these things. And that if you look at our chart here on the right, you know, even in the worst of years, when you look out 8 months and 12 months from where we are today, generally speaking, bonds recover. And now we actually get to enjoy some level of return because we are coming such from a depressed level of interest rates, and you know what banks were paying, you know, next to nothing, and interest rates are just so low that, you know, to have a normal functioning economy, we actually want to see rates increase as they have. But some perspective here, we are starting to see some opportunities in the bonds where we're able to get now 3 or 4%, where previously that was, you know, 2 or maybe less that as far as a yield. Moving on to the stocks side of things, well, not so great either. The third worst start to the year for stocks, and this is dated April 30th. As of where we are today, about the end of May, we're actually about down -18 or so. So we're off and running to really compete with some time frames in the 1930s as being that bad in the stock market. But again, you know, this is it, perspective. So we are long-term investment philosophy. We can't get exactly right when things are going to ebb and flow, but we know that time in the market is very important. And again, out 8 months, 12 months from now, we expect the portfolios to recover and the markets to recover to some degree. So, you know, why is this all happening? You know, why is the markets in such a downturn? And we have a few reasons for that. There's usually never just one. It's a kind of a combination of some things. Right now, it's high inflation. As you sure can see at the grocery store, or if you have tried to book your summer travel plans, hotel rates are up, flights are up, you name it. Most sectors out there have seen high inflation over the past 12 months. And to rein in inflation, the Federal Reserve, the U.S. Federal Reserve, has had to raise interest rates during this time, which is bringing down, hopefully it was bringing down inflation. We haven't quite seen that yet in the data, but that is the idea, is to bring up the interest rates to bring down inflation. And we are seeing liquidity and cash leave some of the marketplaces. Fed has a little bit of control on interest rates. The other two things listed here, we really don't have any control of. These are just outside influences. COVID reemergence here and abroad, particularly China, which is one of the largest economies in the world, has had lockdowns and had like zero COVID policies. And when that happens, as you can imagine, they produce less things, they consume less, which affects the global economy. And so we're seeing some slowdown out of China, which is affecting the global economy. And then, of course, geopolitical risk. Unfortunately, Ukraine and Russia doesn't seem to be having a quick resolution, but that threat is there. And that is also when you look at probabilities of what could happen, there's some uncertainty as to what's going to happen next.
Yeah, and I think that's the one thing, markets do not like uncertainty. And, when we have anything that's creating this uncertainty, it creates this crazy volatility. So uncertainty is just equals bad market conditions or just a lot of volatilities, because investors don't know whether they should stay in, stay out. But for the most part, long-term investors, they're disciplined. Institutional investors are staying invested. And something else that we didn't list here, and we're going to talk a little bit about, is crypto. There's all the cash that's infused into the economy, causing all this. I don't want to call it bubbles, but maybe, for lack of a better term, bubbles, which we'll talk about in a little bit. So I wanted to just throw that, and now we have monkeypox, for God's sakes. I mean, we just kind of put in current events in there. So there's just a lot going on, and so that's what creates this volatile market environment.
Yes, and just kind of recaps it, but just inflation is running at about 8.3% over the last 12 months. And here's kind of a chart of where you can see some of the hardest hit areas: gasoline, airfare, used vehicles, transportation, hotel rooms. A lot of pent up demand here coming out of COVID for things to travel and get back out in the world. So we're seeing some of that in some of those parts of the economy. Towards the bottom, it's high school graduation time. We see education, school book supplies, and college tuition only inflated by 2% over the last 12 months, which is actually lower than what it typically is. That might have some work from the schooling from home and things like that, some components of that. But in general, this is what's worrying the market. This is what's causing uncertainty. This is causing higher interest rates. Trying to get this in check, and we will see where the data lies in the upcoming months, and we will see if the Fed bringing up the interest rates, but also kind of some supply chains and people getting back to work, coming out, getting back to normal, so to speak, coming out of the COVID crisis.
Yeah, and I wanted to add to that, Matt, because I think you hit the nail on the head. The Fed can only control inflation so much by raising rates. Because if we go back to basic economics, right, supply versus demand, and so if we've had a lockdown and just goods haven't been able to be produced, right, it's going to cause a strain on the supply chain. So some of these, if we think about vehicles, that's not necessarily because we've been locked up for 2 years that all of a sudden, there's this high demand for vehicles. But more because they can't produce new vehicles because the parts aren't being produced. Whereas airfare and hotel, if you think, we've been locked up for 2 years and we haven't been able to take all vacations we've been wanting to take for the past 2 years, well, you know what? It looks like countries are opening up. We're feeling more comfortable moving around. So hence the pent up demand on travel. But I think it's important that we know that the Fed can only control so much of this inflation. And so even though you've seen this whole argument on whether inflation is here to stay or is it transitory, the truth is that once we get our supplies back up and running and China doesn't continue lockdowns, we're able to produce a lot of the goods. I think if we take any item in our house and we look at the back of it, including my calculator, it'll say it was made in China. So if production is back up and running, we'll see that this will start taming inflation to some extent. And the other thing that affects markets, if we think about, well, why is this important, is because if we think about earnings, right, and what's affecting earnings for a lot of these companies, it's cost driven, right? And there's only so much of that cost that they can pass through to their end consumer. And I thought it was pretty fascinating that to some extent, and even though we had some earnings in the last couple of weeks and maybe they didn't meet or exceed the expectation, they were a little bit lower due to the fact that they had higher cost of running a business. But their revenues were record level revenues. So from a gross revenue perspective, they just hit it out the park. I mean, people are still buying things. I see it all the time. I was out this weekend and I thought, it doesn't look like we are in a recession in any way because the Lions are making a couple of loops. So needless to say, I didn't wait. I left. I didn't buy what I wanted to buy. But the point is that everybody's out there, everybody's shopping. What we do see, inflation does affect the profitability of these companies, and I think we'll start seeing that that pressure relieved a little bit once the supply chains are back and running.
Very great points, Nella. And so, what also kind of causes uncertainty and maybe helped cause some of the inflation, but just as fast may bring it back down, which is why our outlook on where the markets are headed and what's going to happen into the future is a little bit maybe more tame than what the current market is pricing in. If you look here on the G7 here on the right, these are central banks across the world, and the Fed is the Federal Reserve here in the United States. You can see between 20 and 21 and 22, these lines upwards here are very supportive of the economies, the markets. We were in COVID, unprecedented in modern times of national economies being shut down. And so rightfully so, there was extra support from the government to help things along and make sure that there was not a Great Depression. And so we kind of have two things happening at once. The global central banks are kind of reducing some of their asset purchases, which acts as taking money out of the economy. So think about a balloon. They are kind of pulling out some of the air, and it's going to get smaller. And that's what's happening to some of the economic forecasts. Doesn't mean it's going to be the worst thing ever and we need to bail out of the markets. Just means there might see some economic slowdown. And then on the left-hand side here, the Fed has telegraphed that they're going to continue to raise rates this year. And they've already done a March increase of 25 basis points, a May increase of 50 basis points. They are telegraphing and expecting a June and July of another 50 basis points increase each. And beyond that, they've forecasted about 3 or so more additional interest rate increases. And that is an assumption. That's what they've put out. That's what they forecasted. Doesn't mean that they're not going to reevaluate as the economy slows or inflation does come back in, hopefully to some degree. It's data dependent. They don't just set a course and say we're going to headstrong steamroll into it and not reevaluate it. So, but this is what's causing the in Nella's case, we're talking about the cryptocurrency, Nella, and some of the tech stocks, the work from home stocks that never made money in the first place were up 600% during the work from home period. And these companies were just being valued like we were never going to go back to work, but they never made a dollar. And so now when the world is coming back to quote unquote normal, and that the companies that are being valued today, have good cash flow, they make good products, they have good manufacturing, there's a real airtight business model, those companies are down, but they're not going to be out forever. Whereas you're seeing some of these tech companies get repriced and don't think that they're going to recover automatically because they were coming such a high valuation anyway. And so back in the 2000s, that was kind of across the board in the tech. Today, I would say, I'm not going to put an exact percentage on it, but it's definitely a smaller percentage of companies that weren't making money. But we have some very serious tech companies out there, as you can imagine. I mean, just look at what you carry around in your pocket, an Apple phone or whatever company. And those companies are down, but not out.
Yeah, and I think it goes back to our fundamentals and our philosophy when we're building. I call it, and most of you have heard me say it, but I just love the phrase, it's kind of our lean, mean retirement machine, right? And this machine can't have garbage in it because that's exactly what it'll spit out. So, when we kind of think about how we're building the parts to this lean, mean retirement machine, and it's focused on quality companies that can withstand any type of market condition. If you have quality companies with really healthy balance sheets, an interest rate hike is not going to impact that company because they don't have a lot of debt on their books. So I think it's important that we kind of look at the world and what's changing and making sure that our portfolios still are designed and implemented in a way to kind of keep up with any market condition. And I think this again, all that stimulus put in the economy, it puts so many strains on everything across the board, wages, for God's sakes. I mean, wages, people had to give raises of 25, 50% plus just to make sure they kept employees, because another thing created by the pandemic and this whole work from home phase is that people can work from anywhere. So then we also went through the Great Resignation, which also created, inflation on wages, because it was hard to find people to actually come in and work. But these are all things that as we start to get back to normal, we'll see these things sort of iron themselves out. But I think it's important that what caused all the inflation, and really that bar right there is pretty telling as far as how much stimulus they put into the economy, and where was it going to go but to all the memes and the cryptos, which we've said from the beginning, where it's not something that we believe it should be part of anyone's lean, mean retirement machine.
Absolutely. Absolutely. So, I mean, just to prove what we've been, this is GDP, chart of GDP, this gray line, which is the economic output in the US, and we had a V-shaped recovery. And that came to fruition. We had a lot of webinars like these back during COVID, and we talked about a V-shaped recovery. And with all that stimulus, that's exactly what we had. And it's perfect. It's great. We got back to kind of a normalized economy. In the first quarter of 2022, we've seen a negative print in the economic growth, but that's okay. And even in the word recession, you hear about it in the markets, in the news, and it doesn't mean sell everything in the world is going to turn over and it's going to be the worst ever. Yeah, we might have a little bit of a slowdown, and it could be worse than expected. It could be better than expected, and no recession. We don't know quite yet. But the thing about it is that we are in a period of maybe slowing down and trying to bring down inflation, and that's where we're at. But doesn't mean that long term you should really react to some of the headlines.
Yeah, and I remember when we talked about what that COVID recovery, we debated whether it was going to be a perfect V or the Nike swoosh. But that recovery, and most of you can see it in your kind of that long-term performance graph. It's very similar. The market drop looks just like this, along with the recovery. And I love what Matt said. A recovery, it just doesn't mean everyone's shutting down their doors and we're done. It means we continue growing, but not at the same pace as in the past, which is okay, because we're coming out of a surge. And look at fourth quarter 2021. I mean, we're coming out of an economy that just had all this pent up demand. So it's perfectly normal.
Yeah, absolutely. So to put it in kind of more context here, historically, let's get back to kind of what the markets are doing and where they're at, and when is this gonna kind of not bottom, but kind of find some level of calmness. Right now, we are about 19% down in the S&P 500, the U.S. stocks. This chart just shows different types of pullbacks, 10% or greater, when there are recession periods in the orange, or purple non-recession periods. When there is a recession, no matter mild or strong, the median is about 24%. So the markets are pricing in basically that we're pretty much going to have either a really significant slowdown or potentially a recession. But if you look at or you read some of the headlines out there, they're nasty. They're talking about 2007, where the global financial crisis, and we had investment banks collapsing. That's not gonna. We don't see that happening this time. We don't see that happening. There's just different time periods where people say, oh, the S&P is so overvalued, it's going to be down 50%. That's probable, but it's not our base case. It could happen, but not necessarily what we see throughout time. And so the market, remember, is a discounting mechanism. The stock market itself, tries to look out 9 to 12 months out into the future and sees what corporations are doing, and then tries to value them accordingly. And so we're seeing the threat of interest rates rising and the slowdown in the economy be reflected in the stock market. We're not here to try to say we'll call a bottom. There's an old expression from my trading days where it's on the downside, it's like trying to catch a falling knife. How do you catch a falling knife without hurting yourself? it's very hard to do. So we are trying to exactly call a bottom and catch that falling knife right as it's going down. But we are making adjustments in the portfolio to start taking some advantage of these opportunities with the market being down.
Yeah, and I was gonna add here, Matt, because I think if we kind of try to find a period that the media would like to say, and what we're going through now is just like this. I think the period that they're referring to would be 1973, where we had runaway inflation. And I think it's important that we kind of put this in perspective. You know, the media in particular, they like to use history to create these headlines and cause panic. I think one of my favorite presentations is from the gentleman who demyths all of the historical headlines where here it was, you know, sell now, the market's going to crash. And then the market just does the complete opposite. So I think that if we had to pinpoint, or what they're referring to, you know, what we're going through now is just like this period, it would be 1973. Correct, Matt?
Yeah, those 70s style inflation and higher interest rates.
So I think if we kind of think about the world in 1970s, where compared to the world we live in today, you know, we have technology, we have, you know, we use technology in our manufacturing. So there's no way that we would end up with something similar to the 1970s just because we're a different world, a different economy than we were, you know, what, 50 years ago.
Absolutely, absolutely. And so just a few more charts to kind of put things in historical context. This is one of our favorite ones that we review frequently with our clients, but a lot of numbers here. I'll try to put it together real quick so you know what you're looking at here. The red numbers from dating back to 1980 through today, the red numbers is the downturn in that particular year, what the worst case scenario was that particular year in the US stock market, and then the gray bar is where the year actually ended from a calendar year perspective. And so right now we're down, you know, in that 18-19% area. And on average, the red numbers on an average year, average drop, if you average in the last 40 years or so, the average drop is about 14%. But when you think about it and you see the actual returns for the year, 75% of the time, they're actually positive. And so it's to say, hang in there. We don't know that this is going to continue, or try to time it exactly right and figure out when to really hide and when to press the acceleration. Just know that this rough start of the year usually doesn't last forever. And that's what we're kind of here to say. And this is one of the charts that just shows that volatility happens, uncertainty happens, but typically speaking, the economy and the markets recover. You know, again, this is just the long-term investor gets rewarded. You can see some of these headlines. I'm sure most of our clients and folks watching can remember the 2000s, the dot-com crash, you know, God forbid, the 9/11 terrorist attacks, dating back to the 1980s, where we had US inflation at higher than it is today at 13.5%. In 2008, 2009, the S&P 500 was down 46%. Again, it's down about 19% now. But take a step back, take the long view. This green line is the US market keeps going up. And that's what we want to remind you about.
Yeah, and also a reminder, I think, and I guess human nature will say, well, this time it's different. Every single event, you know, with COVID, well, this time is it. This is all the noise. We take advantage of these market movements. And we're going to talk about what are things we could be doing, which we are doing internally, both from an investment perspective, but also a planning perspective. This is all opportunity, because as long-term investors, we have to tune out the noise and make sure that our portfolios are comprised of investments that are really designed to withstand any market condition, any event, any situation, pandemic, crises, whatever we want to call it, that may seem like different at that time, will just be one among the list here that the market is pretty resilient against.
Yeah. Absolutely. And just to put some numbers behind it, and then we'll kind of talk a little bit more about what we're doing in our portfolios and what we're watching. Just kind of looking at that first example of the blue, some of these different time frames of what happened throughout history. But since that time frame, if you look out 1 year, 3 year, and 5 years, you can see markets recover. It might take a year, it might take 2 years that we're in this neck of the woods, but over the long run, markets recover and you get paid for having your capital invested in the global economy, and you get rewarded for that, by taking some risk and putting your capital into stocks for the long run.
Yeah, and this is that chart, Matt, if you go back, is one of the main reasons why we caution clients. Our clients are, I have to say, throughout this entire period of starting the year with a Russia-Ukraine invasion, our clients are pretty disciplined and understand that this is part of a scenario that we included in their long-term projection. So they've been amazing. They're, the calls have been, yeah, we know this is just, another one of those situations, but we've been prepared for it. But this, if anything, if anyone needs some words of comfort, this is the reason why we don't react to just a temporary market downturn, because trying to time an exit and trying to time an entrance is really a losing proposition, because you're going to miss the recovery. And so this is pretty telling. Again, just to kind of give you the mantra that you should be repeating during market volatility.
Yes, absolutely. So what are we looking for that we would say, okay, what we have kind of projected, the economy may be starting to turn around, or just some signs that say, okay, let's take a deep breath. Maybe the market will kind of pause, rally, or at least moderate, because we've had 7 consecutive weeks of downturn. If inflation has peaked, we're going to see that in the data that's going to come out this summer. That'll be one very heavy indicator of what's happening out in the world. And the U.S. government, as indicated by the Fed, wants to see inflation come down from this 8% level, maybe into the 5% area. And they are going to continue to monitor that as they're raising interest rates this summer. So you're going to hear about June interest rates hike. You're probably going to hear about July interest rates hike. And then we're going to see what they say. And then we're going to see if they reevaluate. One of the Fed governors used a good kind of a good picture in my mind. Even when a ambulance is running through the town with the lights on, they still have to slow down at times to go through lights and to get through the traffic. And that's what's going to happen. The Fed's going to do the kind of the same mantra. We're going to raise rates because we have this high inflation. And then as we get through it, we're going to reevaluate. And if they reevaluate and inflation comes down and the threat of higher interest rates moderates, we could see a very quick spike back in the stock market. As Nala mentioned, corporate earnings very important. Kind of see what the pulse is, see if they can kind of control some of their costs, but also see what revenue is looking like for our high companies across the globe. Things that we can't control, again, China recovering with COVID, and then Ukraine, Russia will be on our minds, I think, a lot this year as we head into the midterms this fall here in the United States. And so what should we be doing, Nella, when we are pretty much, we haven't really used the term bear market yet. Let me just describe that real quick. A bear market is down 20% from the recent highs. So the NASDAQ's in an official bear market. The S&P 500 flirted with the bear market, didn't close in one, but is very close to being in a bear market. So when things are in a bear market, what should we be doing?
I'll say that the tax gods are answering our prayers for some tax planning opportunity. So one of the things to be careful with is obviously not trying to take the off-ramp because the market is not doing well. This is, again, a reminder, this is built into everyone's long-term projections and long-term plans. So this is par for the course. It's part of one of the 1,000 scenarios we run to make sure that your portfolio can sustain with your distribution needs, your cash needs, or your goal. So the one thing we definitely want to avoid is taking that off ramp, because trying to time the exit and then coming back in, it's like trying to move lanes in a traffic jam. You know, you're stuck in the one lane you think isn't moving, so you struggle, and you may say a few swear words and move over to the next lane and then find that that lane isn't moving. So really stay the course. Make sure, you know, if you feel like the portfolio is causing you some anxiety, then what the indication is that the allocation, it may just not be right for you, because that portfolio has to be good for you in good times, but way more importantly, it has to be good for you in bad times, right? It's that you're able to tolerate it. And a lot of it just comes through the coaching and just kind of going through, making sure that we test the portfolio's ability to continue to be on goal. But what I like to do during this time is bank some losses, right? This is the way we're going to pay less to Uncle Sam. And definitely, if I pair a portfolio temporary downturn with a lot of my business owners who may be selling real estate or may have sold a business. So now I'm using this temporary market downturn to harvest some losses and help them save on that tax bill. So I'm really moving the needle on how much they're going to have to pay in taxes from an event that may be totally outside of the portfolio, but I'm using the portfolio to really bank those losses. And when we do tax loss harvesting, it doesn't mean we sell the losers and then sit in cash, because that would be a sure way to shoot ourselves in the foot. So really, loss harvesting is has to be entered into very carefully, because you can't just sell a Tesla and then buy Tesla again because you truly believe in Elon Musk, right? You can't do that, because that's the wash sale rules. So you have to be careful how you're trying to implement a tax loss harvesting. The other thing is, for people who are still in accumulation mode, we're working, we're still putting money into our 401ks. This is fantastic, because we're putting in new money at different price points. So we take advantage of dollar cost averaging. So if you're sitting with cash on the sidelines, look at it as the market being on sale. We all like to go shopping on sale. So this is an opportunity. But definitely, one of the things that Edgar and I did is we accelerated our 401k contributions, just because we wanted to get it in as the market was experiencing a little bit of a downturn. But this is fantastic, because you're going into the market at different price points, and in the long run, that's going to really pay off. Quality. And I don't know if you want to talk a little about quality, but this word, quality, this is what's going to help a portfolio go through any storm. I call it having the portfolio that has the hurricane windows and storm doors, right? Because it's designed to go through any type of market condition. For us, tactical, Matt, if you want to talk a little bit on tactical.
Sure, and just to double down on the quality companies, like even if you're not in the accumulation stage, we are doing things on our side of the portfolio to actually buy into this weakness. Quality companies out there like Amazon down 20, Amazon's down about over 30% this year. Apple down 20-25% this year. These companies are not going anywhere. So we want to buy some of these blue chip type of quality companies at these better prices. So that's what we're doing for a lot of our clients across the board here recently. Again, you can't wait until you think it's the bottom, because it's very hard to figure that out. So we're going to just buy in, and hopefully not, but if it does become even better, more on sale, we'll buy some more. But we'll have those types of companies that have good cash flow, pay a dividend. We love those companies for our portfolio. Tactical opportunities, we see different types of the real estate, for example, real estate sector has been hit pretty hard this year because of the higher interest rates. That's one thing that, as the investment committee, we are looking at potentially to add to our portfolios. Technology, some different areas as a basket and sectors we like to buy into, and that is just generally one of our opportunities to take advantage of these types of market dislocations. But I think overall, we're trying to say, stay calm, remain patient, don't let the headlines scare you too much. Recessions happen, and that is just the way the economic cycles work here in the US and abroad.
Yep, exactly. I echo all of Matt's comments. And if you ever want just reassurance, checking that your portfolio is right for you, I think this, obviously, if we've designed it for you, you'll see that it's something we're constantly checking the pulse on. But I've had some new clients come on and they haven't had that type of portfolio that is meant to go through these volatile times. So they'll see a 40, 50% drop, and that's painful. But we don't have that type of portfolio. It really is meant to be that kind of lean, mean retirement machine.
I like it, Nella. I'm going to do a t-shirt.
I'm gonna get that.
That'd be great. Well, thanks, Nella, for your time. We have one question come in here. We'll touch on this for a minute, but I know folks probably want to take their lunch hour because we're about that time here. But we have one question coming in about I-bonds and the pros and cons of thinking about putting some money towards I-bonds, also known as inflation-linked bonds. Nella, you want to add?
Well, I mean, just put in perspective, the maximum that you can put is 10,000. Sure, if you have some cash on the sidelines, maybe part of your emergency fund that you want to take and just kind of earmark in there, it's not going to really put a dent in the grand scheme of things. But sure, I think why not? I don't know what comments you have on the investment front, Matt, to add to that.
Yeah, no, it's the downside for most is that it's limited to 10,000 per person per year. But on the other side of the coin, it is issued by the U.S. government, so it should be safe and currently paying 9%. Now that's linked to inflation. So as we've been talking, inflation is targeted to go down. So that rate won't last forever. It is a variable rate type of product. So it's something that you can buy today. And if inflation does become in check and the rates go down so much, you'll sell it and move on. But it is something that you would have to go to the U.S. Treasury website and buy them directly from the U.S. government. But it is something that we're seeing some interest in these days from our clients. So thank you, Nella, and thanks everyone for joining us today. And please do reach out to us if you are at all questions about your portfolio, anything you saw today. And for clients and our potential clients who may be watching today, we also do something called a portfolio x-ray, where we look at your positions and we figure out how your positions to how it's going to look going forward for different asset classes and what type of risk you're taking in your portfolio. We're happy to have those discussions. And so please contact us if you'd like to take advantage of that.
Excellent. Thank you, Matt. Thank you all. Have a great rest of your day and call us if you need us to hold your hand through anything. Talk to you soon.
Thanks. Bye-bye.